I love working with you as an ER audience, a Eureka Report audience, and have enjoyed it for the entire time. It's been great fun. You're a very interactive audience, and there are probably people in here who have emailed me over the years, and hopefully I've got back to the vast majority of you. Sometimes I apologise, I don't. Today I'm going to be going through three things. Do I need the clicker, Tony? Sorry, it's up here. So the new super rules, the new super contribution rules, how to maximise your concessional contributions and your non-concessional contributions, and have a look at the incoming pension cap rules, and Max will be going into some other detail on those. So firstly, that is the first slide, yep. The government has said basically on the May budget last year that enough is enough. After 25 years of compulsory superannuation, there's enough in the superannuation system for some people. They've basically ruled a line in the sand there. As I said on budget night last year, these are the biggest changes to superannuation in 10 years and the biggest negative changes to superannuation in 30 years. It's going to get tougher. The restrictions have never been tighter on getting money into superannuation than they will be as of 1 July. From 1 July, the new super contribution rules are going to see that concessional contributions, which are the most common source of contributions, of course, are reduced from $35,000 for the over 50s and $30,000 for the under 50s, down to a flat rate of $25,000 for everyone. There won't be any exceptions to that. That is a limit that will be increased with CPI over time in $5,000 lots. Concessional contributions are those that somebody is claiming a tax deduction for, either your employer or yourself as a contributor. They come as salary sacrifice contributions, the superannuation guarantee, the 9.5% that an employer pays on your behalf, and personal deductible contributions made largely by the self-employed. That changes, and I'll come back to that one. That changes from July 1 as well. Non-concessional contributions are after-tax contributions, the ones that you put from personal savings or the sale of an asset. This is the big one that's coming down from $180,000 per year to $100,000 a year. And for those of you who know about the 3-year pull forward rules, that means that we have a short period up until June 30 where you can use 3 times $180,000 to get non-concessional money into super. From July 1, it will be 3 times $100,000 or $300,000. If you've got 2 members of a couple, that's $1.08 million for a couple prior to June 30, and only $600,000 for both members of a couple post 1 July. Has everybody heard about the $1.6 million limit? Is everybody aware there's 2 $1.6 million limits? So the first $1.6 million limit is the one that's grabbed the vast majority of the headlines, which is this is how much money you're allowed to have to put into a pension account or leave in a pension account if you've already got one started as of the 1st of July. The second $1.6 million limit is actually in regards to non-concessional contributions. As of the 1st of July, if you have more than $1.6 million in superannuation, whether it's in pension, accumulation, wherever it is, you will not be able to put any further non-concessional money into a super fund. If you have between 1.4 and 1.6, there'll be varying degrees that you'll be able to do that. But there are going to be restrictions on non-concessional contributions, including for anybody with 1.6 million or more, no more. You can't put any further NCCs in. If you're sitting between 1.5 million and 1.6 million, you'll be able to put in 1 year's worth or $100,000. I'm talking post July 1 here. If you're between 1.4 and 1.5 million, you'll be able to put in or use 1 year's pull forward. So that'll be 100,000 plus 100,000 for 1 year's pull forward. And if you've got less than $1.4 million in, that'll be the only time you'll actually be able to use the full 3-year pull forward rule to get $300,000 into super. This is the one that is going to stop the mega superannuation funds that we've seen in the past, and is going to make it very difficult to build the really large super funds that some people have been able to build to this point. In fact, if you want to educate your kids on how to create as big a super fund as you can in the future, This is sort of what it looks like. It's not actually going to be possible for anybody in this room, I don't think, unless your surname is Packer, Murdoch, Triguboff, etc. You would start by contributing $100,000 a year from the time your son or daughter was 18 years old. But by the time you got to about 27 years old and putting in the $25,000 concessional contributions, by the time you got to about 27 years of age, somewhere between 26 and 30, you would run out, you'd hit that 1.6 million, you wouldn't be able to put any further non-concessional money into super, but from that point, there's no restriction on the $25,000 going in, so you would actually be able to put $25,000 through until age 65. But the amount of contributions that you're going to be able to get into super is going to be strictly limited to about $2.3 million. It'll go up a little bit over time with CPI, but that's in today's dollars. One of the major improvements to superannuation that comes in on the 1st of July is actually around this 5-year catch-up rules. It's particularly going to help people starting small businesses, people returning to work, small businesses in general. But if you had, for example, somebody who was starting a new business today, the first 5 years are pretty tough. They weren't able to put in any concessional contributions for FY 18, 19, 20 and 21. And in FY 22, they had a reasonable year. They would be able to put in up to the last 5 years' worth of contributions. So 5 times $25,000 up to $125,000 worth of contributions. You will only, however, be able to do that if your total superannuation balance is less than $500,000. So once you've hit that $500,000 limit, then you can't use the 5-year catch-ups any further. The last big change in regards to contributions, which happens on the 1st of July, is in regards to the work test. But I'll come back to that in the following section because it's probably a little more relevant there. There are about 6 to 7 weeks left of the financial year, and that's how much time you've got to make use of the higher limits in order to get as much as you can into superannuation. In the words of John Cougar Mellencamp, which is my generation, possibly some younger generations here, in order to make the most of it, come on baby, make it hurt so good. Get as much money as you can in prior to June 30. It might cause a little bit of pain, but the older you are, the sooner you're going to be able to get access to that money again. And there's some tax benefits, obviously, in the meantime. For those over 50 who are able to contribute, making the most of that $35,000 limit is absolutely critical. It's the last time you'll be able to do it. From next year, obviously, only $25,000. For the under 50s, it's not quite as big a drop from $30,000 to $25,000, but it is the last time that you'll be able to get that sort of money into super. For those over 50, putting in an extra $10,000 is a $3,400 bonus that you can put in for your concessional contributions for this year, and up to $3,400 if you're considering the highest marginal tax rate versus the 15% tax rate for super contributions. How do you get that money in? It's difficult for employers. It's harder for employees this year. In order to do that, there's the 10% test, which means that if you earn more than 10% of your money as an employee, the only way you can make contributions to super is via that employment arrangement. So that either means salary, on top of your SG, that you make salary sacrifice. This is one of the rules that's going on July 1. Next year will be different. They get rid of the 10% rule, and the ability then to be able to make a contribution, a concessional contribution to your fund will be at any time of the year, but you'll be able to make a top-up if you're an employee only getting 9.5%. Your employer doesn't have a salary sacrifice arrangement that he'll allow you to have, and you're on $100,000. You might have put 9,500 will have been put in as SG contributions for you. You'll be able to do a top-up between that 9,500 and the $25,000 concessional contribution limit by simply making a straight contribution to your fund and getting a tax deduction for it to be able to see when you go to see your accountant. This means that salary sacrifice arrangements aren't actually going to be required as of next year. If you have them in place and your employer allows them, then that's fantastic and it's fine. If you don't want to do that or you don't trust your employer to do it properly, then you're going to be able to make those contributions and get the tax deduction yourself. Don't forget, however, particularly in the lead up to June 30 this year, that the money needs to hit the superannuation fund account before June 30. If you make a payment on June 30 and it doesn't appear until July 1, it doesn't count towards this year's contributions limits, it counts towards next year's contribution limits. So if you're doing something like BPay, make sure that you do it several days ahead, the 25th or 24th, so I'm not sure what weekends at the moment, but leave yourself at least 2 days, because if you do it too late and it appears after the 1st of July, it will count to the following year's contributions. On to the incoming pension cap rules. Of the new rules, this is the one that's causing the most confusion and the one that's going to cost the most money for the most people in this audience today. From July 1, we get a $1.6 million limit to the initial starting value of a pension fund. That's for an individual, so a couple can have in a self-managed fund twice that amount, or $3.2 million. If they have had their superannuation reasonably evenly split, or both have more than 1.6 million. Plenty of people in this room know that there's pain to come right here, and will have been wondering what can be done to minimise that pain. In certain circumstances, there will be things that you can do at the margins to reduce it. But essentially, $1.6 million into your pension account, your transfer balance cap, is as much as you're going to be able to do. If you have a defined benefit pension, CSS, PSS, or some other ones that have been out there in days gone by, this is actually where the counting of your $1.6 million starts. Under what's known as the 16 times rule, if you have a defined benefit pension, then you multiply that pension by 16 times to find out what portion of your $1.6 million cap you've used. For example, if somebody has a $50,000 defined benefit pension that they're receiving from usually former work with state or federal government, 15,000 times 16 is 800,000. That $800,000 is counted first towards your transfer balance cap. If you then have another $1 million or $1.5 million sitting in a self-managed super fund, you're only going to be able to leave about $800,000 of that, or transfer $800,000 of that into a pension post 1 July. Then comes the superannuation, any other superannuation balances you have, but the defined benefit is what is going to be counted first. If you have more than $1.6 million in super, what do you do from that point? Well, you've got two choices. I've already spoken to one of the readers here today about what you can do in that. You've got two choices, essentially. One is to pull the money out of superannuation and put it into your personal name. At that point, it obviously becomes a personally held asset and is subject to marginal tax rates at obviously up to currently 49%. That tax goes on July 1, so it'll come down temporarily to 47%. The other option that you have is to move it from the pension fund back into accumulation. In accumulation, it'll only be taxed at a maximum of 15%. I do have one client who has a superannuation balance of approximately $35 million for he and his wife. What's going to happen there is quite obvious. It's the same with a lot of other people, perhaps smaller amounts, where he and his wife are going to have $3.2 million that they're going to be able to keep in a pension. The other $30-odd million, $32 million or so, is going to have to come back into accumulation. No point then bringing it out of superannuation into their personal names, because they also have considerable assets there. So those funds will come back to accumulation. The total extra tax bill that they will have to pay will be around $200,000 a year, but it's certainly better than bringing it out to the marginal tax rate, where you're paying up to 49 cents on the dollar, depending on which year it is. That is what people are going to have to get their heads around, or where some real planning is going to come in. Is what I've written about a couple of times for Eureka is the three-pot strategy. your first pot, which is your tax-free pot of $1.6 million in your pension account, no tax paid, wonderful. Outside of that, the second pot is actually in your personal name, where you get a tax-free limit before marginal tax rates cut in, and depending on what your assets are earning in the way of income, you can probably have about $500,000 to $1 million worth of assets sitting out in your personal name where you're not breaching the tax-free thresholds. The third pot then is, and if you have more than that in there, you're probably better off using the third pot, and that is to have the remainder of your assets sitting in accumulation in super, pardon me, where they'll only be earning or paying tax at the rate of 15% a year. Probably the last one that I briefly want to have a talk about is the transition to retirement. Again, if you want some more detail on this aspect of it, please see some recent articles that I've written. Transition to retirement pensions are going to be taxed for the first time from July 1 this year. There's a very important planning opportunity for those of you, for some of you who have transitioned to retirement pensions, and that includes the ability, if you can change the definition of your pension fund from a TTR, or transition to retirement fund, into an account-based pension or an ABP, then you can save yourself from having to pay tax in that transition to retirement pension pool. How do you do that? There's two main ways of doing it. One, anybody who turns 65, it automatically becomes an account-based pension. But importantly, if you have turned 60 and changed jobs, or 55 and permanently retired from the workforce, you may be able to move that TTR from a TTR into an account-based pension, which will be very important. If you have any doubts, please go and see your financial advisor or your accountant to make sure that applies to you. But anybody over the age of 60 from now on who does change jobs or finishes up work, you want to be telling your super fund and making those changes very, very quickly to get your pension fund changed from a TTR to an ABP. Thank you very much. We'll be not far off moving on. I'll hand back to Tony now. Thank you very much, and I'll look forward to speaking with you a little bit later on with some questions.